As many of you know, Marty is a pioneer in the world of high yield analysis. He's also the CIO of Lehman Fridson Advisors. And we're very happy to say that Marty's analysis can be found exclusively each week on LCD and MI. Marty, I'm going to hand it over to you.
Great. Thank you very much, Nina. All right. Well, my research assistants and I set out to contribute to the ESG discussion by pursuing the question of whether investors are penalized by adopting enlightened policies on environmental, social, and governance matters, as some fear, or whether doing so actually enhances performance, as some ESG advocates maintain. Our laboratory for these investigations has been the U.S. high-yield market. We produced a series of LCD pieces based on our investigations, and our initial findings were summarized in an article in the spring 2021 issue of the Journal of Fixed Income. I will also be reviewing a recent update of our research. All right. Now, the impetus for this particular line of research was ICE Indices' launch of ESG-based high-yield indexes in June 2020. The records for these indexes were created retroactively to the end of 2016, so we now have about 4.5 years of history on their performance. To design these indexes, ICE Indices uses ESG scores generated by Sustainalytics. So all of the issues in creating ESG scores that you heard about from the previous presenters will affect the results that I show you. As of now, these are the best tools we have available to determine the impact of ESG conscious investing on performance. There are 3 versions of the ESG-based indexes that I refer to in these slides. The construction begins with the standard ICE B of A U.S. High-Yield Index. The ESG Tilt Index excludes all bonds of companies with significant involvement in controversial weapons. It then tilts the weights of the remaining issues in favor of those with better, which is to say lower ESG scores. The second index does all that and then further adjusts the weights of these issues so that the resulting index matches the standard high yield index's interest rate exposure across rating categories and industry sectors. Finally, the ICE US High Yield Best in Class ESG Index eliminates both bonds of companies with significant involvement in controversial weapons and bonds of companies with high ESG risk. It adjusts the weights of the remaining issues to match closely the ICE B of A US High Yield Index's rating and industry sector distribution. This table shows that over the 4 years ending 2020, all 3 ESG indexes outperformed the standard high yield index in both absolute and risk-adjusted terms. But when we broke down those 4 years of monthly returns into up months and down months based on the price change on the standard index, we found that all 3 ESG indexes underperformed the standard high yield index in the up months, so their outperformance for the full period was entirely concentrated in the down months. We further found that this happened to be a period in which the winning strategy was simply to be risk averse. The BB index also outperformed the overall high yield index, not only on a risk adjusted basis, but even in absolute returns. And it beat the standard index by a greater margin than the ESG indexes did. These sorts of results are period sensitive. In the 2010s, the BBs beat the riskier standard index in absolute terms, but BBs performed worse than the standard index in the first decade of this century. So we may find over the longer term that the ESG indexes sometimes do better than the standard high yield index and sometimes do worse, simply depending on whether it's a period in which it's advantageous to be risk tolerant or risk averse. Now, in the study described in this slide, we focused on the duration-matched ESG Tilt Index during the horrendous downturn of March 2020. That was the month in which financial markets reached a low point during the COVID-19 sell-off. The ESG index did about 250 basis points better than the standard high yield index in this short period. But we also found that the ESG index began March 2020 with lower exposure than the standard high yield index in the high risk CCC and energy categories. So yes, the ESG index outperformed by 250 basis points in March 2020. But if it had had the same ratings mix as the standard high yield index, the ESG index would have done 170 basis points worse than it did. And if the ESG index had had as much exposure to energy as the standard index did, that would have knocked about 70 basis points off its return. Now, you cannot simply add the 170 and the 70 basis points together to get 240 basis points. Some of the energy bonds were rated CCC, so there would be some double counting if you followed that procedure. Still, it's pretty clear that a lot of the ESG index's superior performance in March 2020 was attributable to differences in composition versus the standard index that were not a matter of including or excluding companies with bad ESG scores. And we'll see a bit, as we'll see a bit later, the differences in composition that help in the bear market can hurt an ESG index's performance in a different sort of environment. Okay. In the next phase of our research, we said, let's take out the ratings of the effect of ratings mix and the energy weighting. Let's see whether bond for bond, good ESG bonds perform better than other bonds. We measured the returns and standard deviations of bonds in the two categories of good and bad ESG scores, matched credit rating for credit rating, and leaving out all energy bonds. Once again, our observation period was March 2020. Now, in this version of the analysis, we found that at 4 rating levels, there was no statistically significant difference in performance between bonds of companies involved in controversial weapons and bonds of companies not involved in that activity. At 6 rating levels, there was a significant difference in return. But in 2 cases, the weapons bonds did better, and in 4 cases, the non-weapon bonds did better. So there was no clear verdict on whether you were better or worse off lending to plutonium producers. Now, we got similar results when we broadened it out to issuers with bad ESG scores for any reason, bad governance, antisocial behavior, or whatever. In most of the rating categories, it was a toss-up. In the 3 categories in which made a statistically significant difference, you did better by owning bad citizens in 1 case and worse in 2 cases. So again, no clear verdict. Finally, in this line of inquiry, we studied the energy bonds that had been excluded from our previous analyses. Sustainalytics gives a few high-yield energy bonds good ESG scores. So we pitted those companies' bonds against peer groups matched by rating, maturity, and subcategory within energy, i.e. E&P, services, pipeline, or integrated. 5 of the good energy companies outperformed their peer groups in March 2020, and 7 underperformed. So yet again, a nearly even split, and no basis for saying that adhering to ESG principles either helps or hurts performance. Now, my last slide presents the results of a recent update of some of our research. Year to date, through May 7th, the duration-matched ESG tilt index underperformed the high-yield index 1.90% to 2.29%. But when we reweighted the standard index according to the ESG index's concentration in energy, the difference in performance disappeared. The reweighted standard index returned 1.91%. So in contrast to the March 2020 results, in which a low relative exposure to energy was an advantage for the ESG index, this year it has been a disadvantage. And that's because energy has outperformed the rest of the high yield universe by about 575 basis points. And energy is the largest industry in high yield. At this point, we have to conclude that at least as far as the high yield asset class is concerned, the reason to follow an ESG discipline is not as a means to achieve superior total return. You do it because you want your investment policy to reflect your convictions about the environment, social practices, and corporate governance. And as far as the available evidence tells us, there's no strong reason to believe the market will penalize you for putting those principles into practice. Thank you for listening, and I'll now turn it back to Nina.